As of 9:43 a.m. Eastern Time, Bitfarms, ticker BITF, is trading on the NASDAQ at $3.30 per share. The market just opened, and it's already under pressure, down $0.07 or about 2.08%. It gapped down from its previous close of $3.37 and is currently trading in a tight early range between $3.27 and $3.46. Now, if you're looking at that drop and immediately checking the price of Bitcoin, you're doing what almost everyone else is doing. But you're also missing the real story. The expectation is that this is just another volatile crypto stock, a simple proxy for the digital asset it mines. The reality is that the future of this company, and the reason for this nervousness, has almost nothing to do with that old narrative. The entire thesis for this stock, for better or worse, comes down to what happens tomorrow. Not today's Bitcoin chart, but the Q3 2025 earnings conference call scheduled for before the bell on November 13th. That single event is a dividing line, and it's why institutional investors are holding their breath. What we're seeing is not a reaction, but anticipation. For years, the playbook for this stock and for the entire sector was incredibly simple. You'd log into your Robinhood app or SoFi Invest account, see Bitcoin was up, and buy a miner like Bitfarms, expecting it to follow. It was a leveraged bet on the asset. People traded Robinhood stock trading as a simple way to gain this exposure without the complexity of holding the asset itself. And for a long time, on a basic level, they weren't wrong. This was the common ground, the accepted wisdom. This stock was a one-trick pony, completely tethered to the highs and lows of the crypto market. That's the story you'll get from a quick glance, the story that still dominates most investing sites. But that playbook is now dangerously obsolete. The company you think you're analyzing is not the company that exists today, and it's certainly not the company it's trying to become. Bitfarms is in the middle of a massive, costly, and incredibly risky transformation. The real story isn't about Bitcoin mining. It's about high-performance computing, or HPC, and AI data centers. The stock is no longer a simple bet on a digital commodity. It's a complicated, high-stakes bet on an industrial-scale infrastructure build-out. This changes everything. It changes the risk profile, the capital requirements, and the entire valuation model. The company is shedding its old skin, and the process is expensive and uncertain. This isn't a simple online investment anymore. It's a speculation on a full-blown corporate identity crisis. Let's look at the reality of the situation. The past few months have been a whirlwind of financial engineering, not mining optimizations. In October, the company announced and closed a massive $500 million convertible senior notes offering. This came right after securing a $300 million private debt facility from Macquarie Group, one of the world's largest infrastructure investors. Now, why do they need all this capital? It's not just to buy more miners, it's to fund their ambitious pivot, specifically to build out their Panther Creek data center campus in Pennsylvania. This is the heart of the new Bitfarms. They are, in effect, trying to become an AI infrastructure provider, a landlord for the new compute-hungry economy, competing in a space closer to NVIDIA stock's ecosystem than to Bitcoin's. It's a bold move, but it's also a bet-the-company-level commitment. This strategic shift explains the other big news, the full exit from Argentina. The company announced it's discontinuing its mining operations there, a process expected to be completed this month. This isn't a minor tweak, it's a geographic and strategic consolidation. They are leaving a high-risk, economically uncertain region to focus all their firepower on the U.S. market, specifically on this HPC AI pivot. This is a clear signal. The old global mining expansion plan is dead. The new plan is to become a U.S.-based infrastructure company. This is the kind of investment help you rarely get, a clear signal from management about where their priorities lie, not in their words, but in their actions and their capital allocation. This brings us back to tomorrow's earnings call. It is, without exaggeration, the most important call in the company's history. No one is going to be impressed if they just meet the analyst EPS estimate of a 2-cent loss. That's background noise. The only thing that matters is a clear, detailed update on this HPC strategy. Management will be pressed for hard answers. How much of that $800 million in new financing is allocated? What is the exact timeline for the Panther Creek build-out? Have they signed any customers? What are the capital expenditure forecasts for 2026? And most importantly, how do they plan to compete with larger, better capitalized rivals like Riot and Marathon, who are pursuing the exact same strategy? This is where the tension lies. The company's last report for Q2 2025 showed the cracks in the old model. Yes, their revenue was $78 million, up an impressive 87% year over year, but they still posted a net loss of $29 million. Worse, their direct cost to produce one Bitcoin was $48,200. With Bitcoin's price being volatile, those are not healthy margins. It shows that the pure-play mining business is a tough, low-margin, high-cost grind. This is precisely why they are forced to pivot. They know the old model is a dead end. The problem is, the new model is a minefield of execution risk. They've partnered with T5 data centers to help, which is a smart move to de-risk the technical side, but it doesn't guarantee success. If you're engaged in self-investing, this is the kind of situation you have to analyze deeply. This isn't a stock you just buy and hold like an Apple stock or a broad market Fidelity ETF. This is an active, high-risk, event-driven situation. It's the kind of stock that many automated Schwab Intelligent portfolios or a Fidelity Wealth Management advisor would likely avoid entirely due to its volatility and binary risk. But for those managing their own individual brokerage account, whether on a Fidelity trading platform or through interactive brokers, the details are everything. The institutional ownership reflects this uncertainty. You have major players like Invesco and Van Eck holding significant positions, likely through their blockchain ETFs. But recent 13F fillings show a mixed bag. Some funds adding, others reducing. No one is moving with unified conviction because the company is in limbo. So what is the core business? It was a global Bitcoin mining company. It owned and operated large-scale server farms in Canada, the US, and formerly Argentina. It made its living by validating transactions on the Bitcoin blockchain and earning BTC rewards. That was it. The new business, if they succeed, will be a digital infrastructure company. It will lease out high-density data center space, complete with advanced liquid cooling, to AI companies, research labs, and other enterprises that need massive computational power. It's a shift from being a gold miner to being a landlord in the middle of a gold rush. The appeal is obvious. The demand for AI compute is exploding, and it could offer more stable, long-term contracts completely decoupled from the price of Bitcoin. But the risks are immense. This is a capital-intensive, low-margin business until it reaches massive scale. And as I mentioned, they are not alone. They are now in a direct race with giants. This is the ultimate expectation versus reality setup. The market expects them to report Bitcoin production and hash rate, but the reality is that these numbers are becoming secondary. The stock's future value is no longer tied to the 19.5 EH/s of hash rate they had. It's tied to the gigawatts of power they can secure and build out in Pennsylvania. This is a construction and energy play, not a tech play. I want you to think about that pivot. Comment below with what you think is the bigger risk, the massive debt they're taking on or the intense competition from larger rivals in the AI space. I'm genuinely curious to see what you all think is the bigger hurdle. As we head into tomorrow, here are the two most likely scenarios. In scenario A, management delivers a home run. They provide a clear, confident, and, most importantly, funded timeline for the HPC pivot. They hint at initial customer interest or a faster-than-expected build-out. In this case, the stock could re-rate. It would begin to detach from the crypto miner ETF crowd and attract a new class of infrastructure investors. The debt would be seen as a smart investment in future cash flow. In scenario B, management is vague. They dodge questions on timelines, they don't provide hard numbers on capital expenditure, they focus too much on the old news, the Bitcoin they mined last quarter. If this happens, the market will punish the stock. It will signal that the pivot is troubled, and that the $800 million in new financing is just a lifeline to fund a money-losing business. The debt will look like an anchor, not a propeller. This is the reality for investors looking for SoFi active investing opportunities or trading on Interactive Brokers platform. The nuance of this call will determine the stock's direction for the next year. It's not like buying Fidelity mutual funds. This is a single binary event. So as we watch the stock chop around at $3.30 this morning, that's what's really happening. We are witnessing the market's profound uncertainty on the eve of the most important day in Bitfarms' corporate life. The expectation is that this is a Robinhood crypto stock. The reality is it's a high-stakes infrastructure project, a bet on a complete corporate reinvention. The old story of just mining Bitcoin is over. The new story of building AI data centers is just beginning. And tomorrow, we find out if the first chapter is a compelling read or a cautionary tale.